Hi guys, welcome back to All Things Wholesome. This is a channel where we discuss all things that teaches about money skills. Today I'm going to be discussing 4 things, which are the repo rate, prime rates, inflation, and credit. So I just want to help you understand how these 4 things are connected and to help you understand what's currently been happening when they say the repo rates or the prime rate has increased. So this video is just for people like me who didn't understand what they meant when they were saying the repo rate has increased. So I just had to do my research. So now I'm here to explain what all that means. In my discussion, I'm going to start by explaining the central bank. So in any country, there should be a central bank. So in this case here in South Africa, we have the South African Reserve Bank as our central bank. So what this does, it controls the amounts of money and credit that flows in the economy, and also it prints money and influences the interest rates. So meaning that the central bank can increase or decrease interest rates as and when required. Now I'm going to be explaining the repo rates, but first I have to explain what commercial banks are. Commercial banks are banks that offer service to us as the public and to businesses. So it's your typical ABSA, FNB, Capitec, Nedbank, etc. Now that I've explained the commercial banks, let me go back to explaining the repo rates. So we have these commercial banks, right, that offer service to us as the public and businesses. These commercial banks sometimes also experience shortfalls, and when that happens, they have to borrow money from the central bank. So obviously, when you borrow money from somewhere, when you bring it back, you have to pay the principal amount, which is the amount that you originally borrowed, and also add interest on top of that. So the rate at which the central bank charges commercial bank is called the repo rate. It's also known as the repurchasing rate. So now I'm going to be explaining the prime rates, which is between the commercial banks and the public or businesses. So when a commercial bank lends the public money, they have a benchmark rate at which to charge the public or businesses. So that benchmark rate is then referred to as the prime rate. It's usually 3.5% above the repo rate. So depending on your lender and your credit score, your interest rate should be more than the prime rate, given that you took your loan with a variable interest. So if ever you have fixed your interest rate, then the repo rate and the prime rate won't affect you, since your interest is fixed and it will not change. Now I'm going to be discussing inflation. Inflation is the increase of prices of goods and services due to a shortage of supply or an increase in demand. So meaning that prices go up because it becomes difficult to get supply of goods or services for whatever reason. It can be war, or it can be a pandemic, etc. So now I'm going to be discussing credit. We all know what credit is. I believe that credit is important in the economy because it allows people to spend more than what they have. We all depend on credit for transactions that we cannot afford. So for example, most of us can't afford cars or houses. So if the interest rates are high, we cannot afford to borrow that money to buy the things that we want. What happens if the repo rates or the prime rates increases is that people cannot afford to borrow money to buy whatever they want or need. Unlike when the interest rates are low, people can go and borrow money and spend it. So what's currently happening in South Africa and the world is that, do you remember during the pandemic, we were not working? We were sitting at home doing nothing, so there was less production, so there was a shortage of supply of goods and services. So that caused inflation. So prices went up because it was more difficult to transport goods and services around. So there was inflation. So now the central bank is trying to fight inflation by increasing the repo rates and the prime rate so that people spend less. Remember, if the interest rates are high, it becomes difficult for some of people to borrow money. So now the light is off due to load shedding, but what I was saying is that they're trying to fight off inflation, because if people are not spending, if people are not buying, prices might go down. Shops may be forced to lower their prices, and then once that happens, maybe the central bank can then lower the interest rates, so which will encourage people to to go and get credit so that they can spend on the things that they want or the things that they need. So hopefully it will get to that point, or hopefully I'm guessing correctly, and we reach that point where prices go down and the interest rates go down, because yeah, it's very difficult for a lot of us as our monthly installments are increasing. It's very difficult. Yeah, that's all I can say. If you want to learn how to manage your finances and money skills, please subscribe to the channel, and don't forget to hit the like button if you enjoyed this video. Even if you didn't enjoy it, please hit the like button. Doesn't cost a thing, and it takes only a second. So thank you for allowing me your space and lending me your ear. Always remember that I love you. Have a lovely productive day. Bye.